The breakdown of the Bretton Woods system of managed exchange rates in 1973 soon led to casualties. On the 26th of June 1974, West Germany's Federal Banking Supervisory Office withdrew Bank Herstadt's banking license after finding that the bank's foreign exchange exposures amounted to 3 times its capital. Banks outside Germany took heavy losses on their unsettled trades, with Herstadt adding an international dimension to the debacle. In October the same year, the Franklin National Bank of New York also closed its doors after racking up huge foreign exchange losses. 3 months later, in response to these and other disruptions in the international financial markets, the central bank governors of the G10 countries established a Committee on Banking Regulations and Supervisory Practices. Later renamed as the Basel Committee on Banking Supervision, the committee was designed as a forum for regular cooperation between its member countries on banking supervisory matters. Its aim was and is to enhance financial stability by improving supervisory know-how and the quality of banking supervision worldwide. The main differences between Basel I and Basel II are described here. We can see that Basel I. The Basel Committee published in 1988 a set of minimum capital requirements for banks, and was enforced by law in the G10 countries. Basel I is primarily focused on credit risk and appropriate risk weighting of assets. The bank must maintain capital, Tier 1 and Tier 2, equal to at least 8% of its risk-weighted assets. Basel I didn't focus on market discipline. As for Basel II, it was initially published in June 2004 and intended to create an international standards for banking regulators to control how much capital banks need to put aside to safeguard against the types of financial and operational risks banks and the whole economy might face. This is done through enhancing the supervisory role over banks and ensure the market discipline. Basel II doesn't require any specific disclosures on liquidity risk. Pillar 3, which is the main focus of our presentation, generally called market discipline, which lead us to ask about why there is a need for this term, and what does it mean. The objective of Basel II Pillar 3 is to improve market discipline through effective public disclosure to complement requirements under Pillar 1 and Pillar 2. Pillar 3 introduces substantial new public disclosure requirements, and will represent a significant increase in the amount of information made publicly available by banks and investment firms around capital structure, capital adequacy, risk management, and risk measurement. Why this is crucial. Pillar 3 relies on market participants to actively monitor the banks in which they have an interest. Broadly, Pillar 3 is a set of requirements regarding appropriate disclosures that will allow market participants to assess key information on the scope of application, capital, risk exposures, and risk assessment processes, and so the capital adequacy of the institution. Investors such as equity or debt holders will then be able to react more efficiently when banks' financial health deteriorates, forcing banks' management to react to improve the situation. The scope of required disclosures is very wide. Here is a summary to the main elements in this table. The qualitative and quantitative disclosures are done to all the following topics: capital, capital adequacy, credit risk management, securitization, market risk, operational risk, equities, and interest rate risk in banking book. The disclosures set out in Pillar 3 should be made on a semi-annual basis, subject to the following exceptions. Qualitative disclosures that provide a general summary of a bank's risk management objectives and policies, reporting system, and definitions may be published on an annual basis. In recognition of the increased risk sensitivity of the framework and the general trend towards more frequent reporting in capital markets, large internationally active banks and other significant banks, and their significant bank subsidiaries must disclose their Tier 1 and total capital adequacy ratios, and their components, on a quarterly basis. Pillar 3 disclosures faces some challenges, especially with IFRS, which is illustrated here in Figure 1, that highlights the considerable overlaps between the requirements of IFRS 7 and Pillar 3. In particular, regarding credit and market risk, most of the qualitative disclosures can and should be aligned. Similarly, there is a considerable amount of quantitative disclosures that overlap, such as the analyses of credit risk exposures and value-at-risk measures. There are differences, however, between the two disclosure frameworks. For instance, Pillar 3 does not cover liquidity risk and IFRS 7 does not address operational risk. In order to present a coherent and credible picture to the financial markets, there will need to be consistency between the IFRS risk and capital management disclosures and the corresponding Pillar 3 presentation. Beyond just IFRS 7, banks will need to review the consistency of Pillar 3 and other risk management disclosures with other public disclosures such as segment reporting. This is key in meeting regulators, analysts and investors' demands for more consistent and insightful information about risk and capital management, and the results thereof. Another challenge that banks face, when preparing for Pillar 3 disclosures, is to establish a governance structure around the disclosure process. Due to the multiplicity of organizational units involved, one of the key risks associated with the production of Pillar 3 disclosures is the lack of ownership of the entire process or the late involvement of key stakeholders. Pillar 3 aims to complement the minimum capital requirements and supervisory review process by developing a set of disclosure requirements which will allow the market participants to gauge the capital adequacy of an institution. Market discipline supplements regulation as sharing of information facilitates assessment of the bank by others, including investors, analysts, customers, other banks, and rating agencies, which leads to good corporate governance. The aim of Pillar 3 is to allow market discipline to operate by requiring institutions to disclose details on the scope of application, capital, risk exposures, risk assessment processes, and the capital adequacy of the institution. It must be consistent with how the senior management, including the board, assess and manage the risks of the institution. When market participants have a sufficient understanding of a bank's activities and the controls it has in place to manage its exposures, they are better able to distinguish between banking organizations so that they can reward those that manage their risks prudently and penalize those that do not. These disclosures are required to be made at least twice a year, except qualitative disclosures providing a summary of the general risk management objectives and policies which can be made annually. Institutions are also required to create a formal policy on what will be disclosed and controls around them along with the validation and frequency of these disclosures. In general, the disclosures under Pillar 3 apply to the top consolidated level of the banking group to which the Basel II framework applies.